trillion bill, an actual, real, live, it was a real money. And I thought, well, that's pretty cool. So I went and we have like a, really high-end printer in our home, or not our home, our office, copy machine. So I put it on there to copy it. Anyone know what happens? Shuts down, alarms come off. I'm like, what the? Turns out that copy machines have a sensor in it, and if you copy real money, it shuts down, and they're supposed to contact the FBI. And so we had to call the service company and they come out and goes, well, anyway, it turned out not to be that big of a deal, but it's literally shut down until a guy comes out and resets up your computer. And if it would have been an American dollar, he would have had to turn me into the
oh my God.
Secret Service.
So you're telling people, be careful what you do with
Exactly.
this.
Don't go copy it.
So we want to get this started. What do you normally do when you...
Yes, actually, I want the other one here. Sorry, okay. 1 sec.
There you go.
Okay, great. So, yes. All right, so just to kind of give you guys a little background here, I have two hats. I have a securities license, right, which allows me to do stocks and bonds and all that kind of stuff. And I also have a real estate company, and they're separate. Two different licenses, two different things that we deal with. Anyway, Dan, most of the speaking I do now is for real estate, but Dan had asked me to talk about REITs. So we're going to start off kind of with my securities hat and this whole area. And taking advantage of real estate, but there's a lot of investments you can do besides buying property yourself. So again, we're going to talk about that a little bit. I'm actually down in the LA area. San Marino is right in the bottom side of Pasadena, and I've been there now for 20 years. Anyway, I'm going to kind of skip through this. We do a lot of stuff. It may seem odd having 1031 exchange information up here when we're talking about the security side of the world. Probably 15 years ago, there were some law changes that allowed you to set up, or let companies set up what they call tenants in common structures, or Delaware statutory trusts. And those are a syndicated structure where you can exchange into that and be a partial owner of a building. So that became a big thing where they would go out and buy a shopping center or a big apartment complex or whatever and structure it, to fit all these rules. And then you can actually buy in 5% of it or exchange into it 5%. And so that became a big thing, and it still is. So again, if you want to do something like that, you can go through and do it as a partial owner. A lot of the people I deal with, let me just adjust this real quick. Whoop, there we go. A lot of the people I deal with tend to be older. They've owned their property for many years, and they've used up a lot of the depreciation that they have in it. And so, they're taking a look at that. When the first exchange I ever did was actually an older couple. They had a smaller apartment complex, and they said, Rusty, we're just in the stage of life now where it's too hard for us to run around managing this property. Your kids have all moved out of town. But we went to our CPA, and it was kind of a shock when we found out the taxes we had to pay. What can we do? Well, that's when I learned about 1031 exchanges. So I helped them with that transaction. We got through. We got them into some property where they didn't have the management headaches. But since then, that part of the business has grown and grown and grown until probably 70% of the transactions I'm involved in are some form of 1031 exchange. A lot of those same people have retirement accounts. But I'm going to segue a little bit here because, as you all know, interest rates are at an all-time low, right? And this is changing the world, the financial world, dramatically. So where I'm coming from here is that everybody wants income. So there's a lot of people out there that are retired, and probably some of you guys, or even just investors where they want to put their money somewhere where they're getting a half-decent cash flow. Well, when we talk about interest rates today, it's really, really hard. And it's getting harder and harder to find places to place your money to give you some kind of half-decent return. And you'll see where I'm heading with all this in a few minutes. So again, you guys know this already. If I would have stood up here, 12 or 15 years ago and said, folks, you're going to have trouble finding an investment or even a CD paying more than 1%, what would you have said? It'd be crazy, right? I mean, back then, we never could have imagined interest rates going this low. It never happened before in our lifetimes, and we just couldn't imagine it happening. But it did, okay? And so in today's world, trying to find a CD or a low risk investment that's paying any kind of half-decent cash flow is hard to find. Now, I like talking about 10-year treasury rates, and that's because the whole world wants to invest in U.S. Treasury bonds. They're considered one of the safest investments in the world. And traditionally, large pension funds, insurance companies, institutions would take a big chunk of their money and they would invest it into U.S. Treasury bonds, and they would get somewhere around 6% return on their money and have their money in something that's very low risk, okay? Today's world, it's dropped down. Right now, it's 1.7% for a U.S. Treasury bond. And so for these large institutions and, like I said, insurance companies, et cetera, that's tough. You know, they can't make their numbers work if they have a big chunk of their money only making 2%, okay? So they're out there struggling, trying to figure out what other investments they can go into. And it's not just these big institutions, it's also individuals. I've had people come in the office and say, Rusty, I had this bond or I had a CD, it's matured. I need to figure out where to put that money, because if I go get a new CD or a new bond, the rates are so low that I can't do it, right? I can't live on 1, 2, or 3%. So we know that the rates, well, let me go to the next slide here. So the big question is, what's going to happen down the road, right? That's the trillion-dollar question, and it's kind of interesting to see what's happening. When we had Janet Yellen in power running the Federal Reserve, every year she talked about, oh yeah, we're going to raise interest rates, but did she? Well, if you were watching the stuff back then, she kept talking about raising interest rates. She didn't until the end. She raised them just a little smidgen. And then Trump came in and he appointed Jeremy Powell, and then he did actually start raising interest rates. So the last couple of years, we saw rates going up. But then when rates went up, at the end of last year, Trump actually started complaining, saying, hey, whoa, you guys are raising them too much and you're going to, affect things in a negative way. And if you're following, I mean, I know in our area, real estate, it did slow down. Okay, at the end of last year, we did see a slowdown, especially in the bigger properties and commercial properties. And then they started lowering rates early this year, and they actually started lowering them more than we expected. And things really picked up. Right now in LA, it's frothy. Properties are going really quickly. I can tell you lots of examples. We had a client I know was trying to buy a property weeks ago in Duarte, which is outside of Pasadena, and it was a fixer-upper, and there was over 22 offers again on that property, and a lot of them are all cash. And so it's an interesting environment right now. But the interest rates, okay, now where I'm going with this, obviously as real estate investors, we want to understand interest rates because, going and getting a loan or whatever, but it's the entire market. Stocks, bonds, everything is being affected by these interest rates. So we want to know where they're going and what's happening with them. And again, I'm going to lead into a bunch of other stuff we're going to talk about. But one interesting way to look at interest rates, because again, everybody's trying to figure out what's going to happen with them, and they did drop more than we expected this year. Where's it going to go? Okay. Well, I like looking at rates on major countries around the world just to compare. And this is very fascinating. So if you were to buy a 10-year bond from China, it's going to pay a little over 3%. You're going to buy a bond from here, well actually it's more like 1.7%, Greece 1.4%, Canada where I'm from 1.3%, Hong Kong 1.3%, Italy is around 1%, so you see a pattern. Taiwan 0.7%, UK is about half, Japan has gone negative, France has gone negative, Germany has gone negative, and so is Switzerland. Now I don't want to go into a big explanation on negative rates because it's kind of very counterintuitive, but the main point here is that, first of all, we think our rates are ridiculously low, right? The truth is our rates are actually higher than most of the rest of the industrialized world, okay? And what does that mean? Well, if you're sitting over here in Germany with negative rates and you're thinking, okay, I've got a big fund here and I got $100 million to invest, do I buy German bonds, right? Or do I send some money to America and get some American bonds? What are you going to do? You're probably going to buy some US bonds, right? And that's exactly what's happening. Money's coming here from all over the world, okay? And I know in LA everybody's familiar with money coming in from China and Taiwan and Hong Kong and stuff. But the truth is money comes in from everywhere. You're probably surprised to hear this, But in the last 10 years, there was only 1 year that the Chinese bought more real estate in America than Canadians. Canadians traditionally buy way more real estate in America than the Chinese. Yeah, you just don't really, well, first of all, it's money that's spread out all across America. It's not just in LA, whereas LA is very concentrated with the Chinese. Anyway, so that's just an interesting thing, but the point is that with our rates being higher than everybody else, and our economy being one of the best in the world, money's coming in here from all over the place, right? It comes in from Central America, it comes in from Europe, all these different places. Everybody wants to have money in America. So when everybody wants to buy something, what happens to it? It goes up in value. So if you look at the American dollar and compare it to other currencies, the US dollar's gone up a lot, okay? And especially in the last 5 or 6 years. And if you go, for example, I'm sure you guys travel, you go to Mexico, and it's a great deal right now, right? The peso's down quite a bit. We went to Europe this year. The euro is down quite a bit. Canada, like I talked about, I'm from there, and probably 6 years ago, the Canadian dollar was pretty much on par with the US dollar. Right now, the Canadian dollar is down 25 to 30%, okay? But it's really not that the Canadian dollar went down, it's the US dollar that went up, because the US dollar is up compared to just about every other currency. And that's because everybody wants to come here because our interest rates are higher and our economy is doing better. Now, we're really pushing this whole thing of making America great again. We're trying to bring home a lot of manufacturing, et cetera, which is actually happening. But if our dollar is that much higher than everybody else's, what happens? It makes it really expensive for us to sell our goods. And it also makes it more attractive to keep making, manufacturing in other countries, right? Because we're getting a big deal just on the exchange rate. So we can't afford to have our dollar that much higher than everybody else's. And so I really think one of the big reasons why they've been lowering our rates isn't because of anything other than the fact that we're that much higher than everybody else. And it's actually, we have to keep it from being too much higher, or the dollar will go up too much more, and it'll actually create a negative effect on it. Yes?
Would you say that the reason it's down everywhere is because the global debt is so high, or is there some other reason?
Well, again, it's not so much that the other dollars are down as it is the US dollar's up. See what I'm saying? Because again, you go and compare all these other currencies, and the US dollar's gone up dramatically against them, right? Now look, the whole debt issue is another whole, yeah, and if you want to read a good book on it, there's a book called This Time is Different, and it's a very good study of debt and on country level, what they call sovereign debt, and I highly recommend reading that book. There's actually a great podcast on it too if you Google it, but it's a very in-depth study, and it'll enlighten you quite a bit on debt. And just to make a quick comment on that, and that's another reason why our rates, we can't put them too high, because how big is our national debt right now on the government level?
2 years.
It's around $22 trillion. So think about this for a minute. If our interest rates went up 1%, how much more interest is that we'd have to pay on the US debt? No one's got a calculator? It's about $220 billion extra in interest, just 1%. That's a lot of money. And if you read that book that I was mentioning, they're saying that the magic mark for debt on a sovereign level, a country level, is 110% of GDP, which is about where we are. Our GDP is somewhere around 26 trillion, I can't remember the exact number, but 24 trillion, somewhere in there, and their debt is 22 trillion. So we're right at that level. According to that book, they went back 800 years studying all these different countries. There's never been a case of a country that didn't have a problem with their debt. They had to stop making payments or something on it, that went past 110% of GDP. Virtually every problem you've seen, like with Russia and Brazil and all these other countries, they went past 110% of GDP, and then they had a problem with their debt, big problem. And unfortunately, a lot of these countries are past that mark, so we'll see what happens. So that's a scary thing. But the main point here is, when you're looking at interest rates, how it affects things, and where we are compared to everybody else, we're way ahead of everybody else as far as higher interest, and we can't be that much higher than everybody else. So, I've been saying this for a long time. I think there's more pressure pushing interest rates down than there is pushing them up, even though last year they were raising it. And we haven't even hit a recession yet. So what happens to our interest rates when we have a recession? they're gonna go down some more. So this is a big impact on all the financial markets, okay? All right, so we have the Trump effect. You know, Trump is actually doing really well as far as the economy. You know, there's a lot of things he said lately. He goes, look, love me or hate me, you're gonna vote for me because the economy's doing really well. And so the tax cuts and other things he's done have actually been kicking in and doing very well. So we'll see how this plays itself out, but we're in no man's land here. We've never had a scenario before, except in the last 10 years, where we've had interest rates this low. And we've never had a situation, it's never happened before, where there was negative interest rates in some countries. So we're kind of in no man's land right now overall, but it is something we want to be careful of, because again, when you're talking about real estate, these interest rates are making a big difference. So where are the opportunities? So again, with interest rates being so low, and I talked about pension funds and, you know, institutional money, that kind of thing, everybody's out there looking for a place to put their money, and there's a lot of money out there that's making more than 1 or 2% interest, okay? And it's affecting everything. Okay? I think it's one reason why the stock market's gone up so much. I think it's another reason why real estate's been going up so much, especially rental properties. You can pick rental properties anywhere in the US, and there's a lot of people wanting to buy rental property, okay? And I think one of the reasons is they're getting a better cash flow off that rental property plus the tax advantages than they are their other types of investments. And I've seen it many times in my office. Someone comes in and says, I have a CD that matured. I don't want to put it back in CDs because what's 1% or 2%? So then they go out and they buy a rental property. They buy a property for their kids. They buy, you know, a fourplex, whatever it is. So it's pushing a massive amount of money into real estate that wouldn't traditionally be going there. People would be putting into some other stuff. So again, we'll see where this plays out, but rental properties right now is very attractive, no matter how you look at it. You know, it is kind of tight lending, but in LA market, 45% of all transactions, whether it's single family, apartments, you know, shopping centers, you name it, 45% of those transactions are all cash, which is one of the highest they've ever seen, which is telling us what? It's not just low interest rates on mortgage that's causing people to buy, because almost half the people buying aren't getting mortgages, surprisingly enough. So I think it's because they're going, well, do I put my money into this real estate or do I buy something else? And they're thinking that the real estate is a better option. And if you look up pension funds, for example, and endowment funds, things like that, they always show that there's a certain amount of percentage of their portfolio they want to put into real estate. They've all in the last several years increased it because, again, they feel that they're getting a better return on their real estate than they were in their other assets. So it's pushing money into the real estate market at all different levels. Big properties, small properties, middle-sized properties, you name it. So it's kind of interesting. Okay, so one other thing that's good for real estate is population growth. And America actually has one of the best population growths in the world. We add about 3 million people a year to our population, about 1%. Yeah, a lot of people. And so, obviously, if you have a growing population, you need more houses, you need more shopping centers, more schools, you know, et cetera, et cetera. And so that, and they say that about, that's a combination of the immigration. I think we, you know, with legal immigration, average something like 1 million people a year, and then the other's the birth rate, okay? Now, again, that's really healthy for any kind of economy. When you look at other countries, it's kind of interesting. And again, if you Google this, there's some fascinating videos and stuff. But there's, Germany just recorded the lowest birth rate of any country ever in history. Now, what does that say about their long-term projection on their economy? It's not good, right? Because you're going to have less people. And again, they're having something like 1.1 or 1.2 babies for every 2 people. And that's one argument why they're saying that a lot of these countries are allowing a lot of immigration. They're trying to make up for the low birth rate because it's going to be a big problem economically. Japan, if you Google them, you'll be really fascinated. Japan has been shrinking by something like 400,000 people a year for a while. It's not just been happening recently, but you go back years. There was actually an ad I came across randomly at the beginning of this year, and they're advertising you can get a house in Japan for free. Yeah, there's in the millions of empty houses over there. And same thing happened in Detroit. They want someone to take over that property and actually maintain it and pay the property taxes because they don't want these empty houses. Yeah, so who wants to buy a rental property in Japan? Right? You lose a tenant, and then it's really hard to find a new one. Or you have to really lower your rents. Yes?
And don't have much immigration in Japan like Germany?
Again, Japan is, they actually don't allow immigration.
That's what I thought.
I have a friend of mine that lived there for a while, and, you know, you don't see anything but Japanese there. If you're, you know, not Japanese, you really stick out. Yeah, they're really very strict on immigration. So that, you know, right now they just need to be encouraging people to have more babies. It's a real thing. In fact, oh yeah, another thing, last year was the first year any country in history recorded, actually had more diapers issued, adult diapers, than baby diapers. Yeah. I don't know where that stat came from, but anyway, someone told me that. All right, well, again, America has very strong growth, very healthy, very good for real estate. Now, banks, you know, they are lending, it's actually loosened up, and actually changes. There is a lot of new construction now. This is actually an older slideshow, so that should have been updated there. But anyway, the point here is that you are seeing a lot of construction, okay? I live in Glendale, my business is over in the Pasadena area, and you're seeing tons of apartment buildings and tons of condos and everything else being built, and they're filling up real fast right now. Which is leading to the fact that because there's been such, well, let me go back a little bit. We had about a 5-year period after 2008 when nobody built anything, right? We had the crash, and if you're a developer, you either went out of business, or if you stayed in business, you couldn't get a loan, because banks just wouldn't give loans or anything back then. So we went through that whole period of no new construction. Now, did people stop having babies? No, we still had babies. The population still kept growing at 3 million a year. So we had this pent-up demand where there was a bunch of years where no new properties were built, and a lot of young people were living at home, right, because they couldn't get a job, etc. And now that the economy's booming and we've had the population keep growing, there's a huge pent-up demand, and it's not just LA, it's across all of America, any major city. And I've been to a lot of cities in the last few years. Virtually any major city you go into right now, there's a lot of cranes, right? And everybody's telling me when they put up a new multifamily or condo, it gets filled real quick. And so you're seeing very little vacancies. If you guys, I'm not that familiar with the Santa Barbara market, but down in the LA market, if you lose a tenant, you get a new one right away, and you can probably raise your rents. Okay, so it's a very healthy market right now for real estate. At some point, we'll overbuild, and so again, there's been a lot of building, so I'm not sure how close we are to that, but you do have to be aware of that. But again, it's very, very healthy right now. Okay, so I'm kind of giving you the big picture here, and one reason I'm talking about this now is, obviously it's important to understand a lot of this stuff with interest rates and everything else having to do with real estate in general. And Dan really asked me to talk about REITs, so I'm going to go over that for a few minutes. First of all, a REIT stands for Real Estate Investment Trust, okay? And it's basically a structure very similar to a mutual fund kind of concept, where you have it's filed with the SEC, and it's designed to go public, or be public already, and instead of buying stocks inside that fund, they're going to buy real estate. So I'm sure you guys are familiar. There's mutual funds that buy just bonds, and there's mutual funds that buy, European stocks or South America stocks or high-tech stocks or growth stocks. There's all these different categories of mutual funds. So you can kind of think of a REIT as being very similar to that, but instead of buying other companies, they're buying property. And so there's a lot of different REITs out there. Most REITs will focus on one type of asset. For example, there's a lot of apartment REITs out there. There's retirement home REITs. There's medical office building REITs. There's REITs that focus just on triple net lease properties. There's a whole range of them, okay? And so the ones that you're going to see, you can go online and Google or go into whatever. In fact, I'll show you a couple in a minute. But you can go online and pull up some REITs, and you'll see, you can check a little background, find out what they're investing in, et cetera, et cetera. So that's really the idea of a REIT is, instead of going out and buying a property yourself, you can put money into a REIT, and you're in a whole portfolio. And then if your timing is good and everything else, that REIT, should do good. And then when you see a dividend off of a REIT, that's the interest off of that portfolio. Well, it's going to be interest if they have mortgages and things, because some REITs will actually do mortgages as well, like they'll lend money, but also it'll be rental income. So most of the REIT dividends you see is really rental income off the portfolio properties that they have. And one interesting rule having to do with REITs is that by law they have to distribute 90% of what they collect. And so, again, a lot of people buy REITs because it's almost like buying some kind of bond, right? People will buy a bond or a CD because they're gonna get a monthly check off of that, and then that'll be money they use for the retirement or whatever they do in their portfolio. You buy a REIT because you're gonna get consistent cash flow from that REIT based on the rent they're collecting on those properties. So just like any real estate, you wanna have a little bit of idea of what they're investing in to make sure that that type of property is gonna continue to pay its dividend down the road. Yes?
You say on the REIT investment, you're not confined to like a 6-month CD or a 10-year or something like that, you can get out of it anytime you want, generally speaking?
Correct. If it's a publicly traded REIT, which is what you guys are gonna see, correct. You can buy and sell that just like you would any kind of stock. And it's gonna be traded on the New York Stock Exchange. And so, you could buy one, and again, if you open a brokerage account, you could probably buy a REIT for $5,000. So it's a nice, easy way for someone to buy something that's in real estate without having a lot of money, and you're gonna get a dividend off it, and depending on the REIT, it's probably could be anywhere from 3 to 10% cash flow on the dividend. Okay? Yes?
Or you choose to have the dividend just put it back into the REIT, or is that a possibility?
It's up to you. Some REITs you can do a dividend reinvestment program and buy more shares. Some of them you just have the cash distributed and you save your money up. And for some, I have a lot of people I've dealt with that will buy REITs and then the income comes in as part of the retirement income. That monthly dividend. Yes.
So if I have a real estate property, rental property, do a 1031 exchange, I can invest in the REITs without paying any capital gain tax and derive income from that, or?
Well, yes and no.
Okay, there we go, disallowed, I've heard that word
Well,
before.
let me explain. Okay, and I've done these transactions, so I know them. So if you have a property and you want to do a 1031 exchange, normally you're going to do it into another property, which you have to do that. You cannot exchange directly into a REIT, okay? Because a REIT is not a property, you're really buying stock, okay? So, I've had it happen where I had a client, he had a property down in El Segundo by the airport there in LA, and a REIT wanted his building. Him and some buddies had an industrial building down there, and so in that case, the REIT bought his building and they swapped him for shares in their REIT. And so that was one way of doing it. Now, chances are you don't have a property that a REIT wants to buy. So there are some REITs out there, and again, I've done these, where they will have a building and you can exchange into that particular building. They will hold it for about 2 years, and then they will give you the option of swapping into their shares. And that would work.
Question, how about something, a property that you can build units on, but would have to go through all the paperwork again?
I'm not sure what you asked, so, you're asking if the REIT would do that for you, or?
Yeah.
Again, it's up to the REIT, but truthfully, most REITs are looking for good cash flowing properties, because they're gonna have the whole world looking at their dividend. And so, most REITs that I'm familiar with, someone will do some development deals, but in the end, they're really trying to find good cash flow.
Okay.
Most REITs, yeah. If you want to develop a property, it's probably gonna have to find some partner or someone that's gonna want to do a development. And there are companies out there, but that would be a different scenario. But as far as doing a 1031, you can do a 1031 into a REIT if you follow the steps I'm talking about.
Okay.
There's actually very few REITs that offer you the option to do that, but you can do that. Okay, so what else was I going to say here? There's also non-traded REITs, and they actually used to be real popular because when a REIT goes public, they have to be pretty big. So how do you get to be $1 billion REIT and go public? So a lot of REITs, what they'll do is they'll be non-traded at the beginning, and you buy into it, but you can't trade it on the stock market. You might have to wait 2, 3, 4, 5, 6 years maybe before they get to the point where they can go public. So that's another option that comes up. So again, something on the stock market is going to be liquid. It's going to go up and down. That's how a traded REIT, because it's traded in the New York Stock Exchange. But a non-traded REIT wouldn't be liquid, because you're going to buy into the shares and you just have to wait until the company goes public, and then you can sell your shares. I'm just going to show you a couple samples here of some REITs. I'm just going to pull up Yahoo here. Yeah, here's one I got. Let's see here.